Dear participants, welcome to my video presentation for the International Conference on Management, Research and Economic Development. This conference is the fourth one, and as all of the conferences, it is aimed at topics such as business, finance, management, and economics. And one of the topics for the conference is also my topic, and this topic is aimed at financial innovation, risk governance, and dynamics of global capital flows. So please let me just share my slides with you. Okay, so as I already said, my presentation is aimed at this topic. Let me introduce myself. My name is Lukas Vartiak, and I am from Comenius University, Bratislava in Slovakia. I am associate professor at the Faculty of Social and Economic Sciences. First of all, we have to mention that since this presentation is for the international conference, also we must be 100% sure that the financial investments and the money in general flows internationally and globally. That is why the global capital flow is faster, it is larger, and of course, it is more state contingent. So what does it mean? It means that there is a gross cross-border flow that is way higher than just domestic flow. It reacts quickly to global risk sentiment, and also it can be influenced by the funding conditions and global funding conditions. What is also important to mention is technology. And thanks to the technology, the friction is lower, so it is reduced, and repricing is way quicker or way faster. Another topic that must be mentioned is Forex or foreign exchange market. And what are the key lenses of this global capital flow is that the financial cycle links risk-taking, credit, and also capital flows. When we continue this topic to the innovation stack, we have to be sure to mention, or we have to be able to mention the new rails that are considered nowadays when we want to invest financial capital. One of them are real-time payments, then also open banking and embedded finance. New assets are considered to be stable coins, deposits and securities that are tokenized, and also digital collateral. Intermediaries that also, some of them are new in the market, are platforms, market makers, AI providers or cloud providers, and NBFIs. Data that is collected is also something new in this case, because this data is made or collected by or stored by AI, and also we use the alternative data. What is important to mention about the financial market nowadays is that when we are talking about its global reach, it is available 24/7. It also means that we still have traditional markets, and traditional cross-border market usually face slowing, or it is slowed by batching. Then there are time zones and also capacity of the banks. But in digital world or digital rails, we do not consider these issues because these markets are always on, and decision is usually made very quickly, very fast, and it can be changed anytime. Repricing is very fast, and also transmissions take only a few minutes. What are the implications? Faster runs and dash for cash dynamics. Then algorithmic liquidity that vanishes under stress, and operational and data cyber events that can become micro or macro financial shocks. In this case, more macro than micro, because we are talking about the global markets. Then what drives slow surges and sudden stops today? Global financial conditions include not only USD funding and also appetite for risk, but also rates and volatility. When we consider some leverage and risk limits, usually we can talk about margins and redemption needs. And at the end, all of the hedging costs, such as basis, collateral, and margining, go together with return differentials. So we have to consider all of this. And tech frictions are lower, and they can also amplify not only inflows, but also outflows. Another interesting fact about the global financial markets nowadays is that we consider application mechanisms and spillovers. Positioning becomes common when we are talking about benchmarks, ETFs, model-driven strategies, AI model strategies, and also risk parity. We have to talk about funding because market liquidity spirals consist of margin calls, fire sales, and collateral runs. When we put together all of the cross-border channels, we can talk about forex swaps, also brokerage that mainly is prime, custody, and clearing. Usually, all of the situations in these dynamic and digital markets are non-linear, and it also means that small shocks can trigger big repricing. When we take this presentation to its second part, it is aimed at systematic risk in a fintech and also digital assets era. In general, we can consider all of the reporting of emissions, also offsets and net zero in terms of CO2 equivalents. So, for example, we consider units such as tons of CO2 and sometimes megatons and gigatons. So it depends. And CO2 is a very important indicator when we want to invest into financial markets. But we have to remember that this is not only or the only one indicator. There are more indicators. We can create a risk map. Risk map consists of liquidity mismatch and redemption runs. We are talking about not only funds, but also stable coins and platforms. Another thing that we have to consider is a leverage. It includes synthetic leverage and also its interconnectedness through collateral change, bridges, and also service providers. Then opacity or data gaps include offshore venues and private markets, and operational risk include cyber incidents, cloud concentrations. We also can include AI here and outages. And also the last risk that we must take into consideration is the integrity risk, because some of the frauds and sanctions evasions typologies may happen. Case lengths for the stable coins as cross-border cash-like instruments are. They are they are crucial because they are available 24/7. Then We must consider its liquidation. Pure fragility consists of run risk and reserve assets liquidation. And spillover channels are usually short-term funding channels, forex substitutions, and payment links. The focus of governments is at oversight issuers, also transparency reserves, and rights to redemption and interoperability. All of the markets must be regulated when we want to get the or be able to compare the activity, risk, and regulations at the several markets. When we talk about tokenization, tokenization is or comes with efficiency promise. Efficiency promise means that the settlement is atomic, collateral mobility is very fast, and reconciliation costs are low. Stability benefits, or just potential stability benefits, since we are talking about the tokenization, are better transparency and risk controls, but only if they are well designed. Key risk nodes are smart contract, operational risk, Oracle dependence, and interoperability and bridges that are available. And fragmentation risk consists of multiple ledgers standards. And also, last thing that must be mentioned here is the need for the governance, because there are several standards and the treatment for possible insolvency must be set. Nowadays, it is very important to mention that AI is something that is considered. AI is the part of our everyday life, and it also is the part of financial life or financial market. AI can be used for trading, market making, credit scoring, and customer services, but there are risks. The first risk is that there's herding and also feedback loops. That is why we have to solve this by taking or the monitoring the AI decisions and making the decisions for ourselves and not let the AI to decide for us. That is why we have to model the behavior of AI usually under stress or under circumstances that are not ideal. Then in general, when we take this presentation to its last, final part 3, that is aimed at risk governance, we put together regulatory perimeter, tools and supervisions, and all together with cross-border coordination, they create resilience and integrity. So regulatory perimeter capture risk wherever they occur or try to find the way or the place where they originate. Then close regulatory arbitrage gaps are here to be considered. And also we have to address key gateways such as stablecoins, insurance, and custody. When we use tools and supervision for this, we can divide these tools into micro-prudential and macro-prudential. Micro-prudential include all of the capital, all of the liquidity, governance, and so on. And when we compare it with macro-prudential, it includes leverage, limits, buffers, liquidity, and backstops. On the other hand, everything must be supported by the technology. So that is why we use subtech and also Reshapes. And to be resilient and integrated, we have to include into this model cross-border coordination with common standards to reduce fragmentation, usually international standards, financial standards, and investment standards. Then we have to talk about memorandums of understandings, data sharing and supervisory colleges, and crisis management, of course. When we move further with this presentation, we have the governance challenge number 1, that is the moving regulatory parameter. Bank-like functions into platforms are unbundled or transferred by innovation. Arbitrage risk include activity that migrates to less regulated venues and jurisdictions. And the main principle is to regulate by activity and risk and not by entity label. It means that the data must be governed by licensing, reporting, and mapping. Who is the supervisory capacity here? As was mentioned, subtech, regtech, and tech expertise. Governance challenge number 2 is or represents cross-border coordination and information gaps. It means that capital flows respond to relative regulations by unilateral moves. Then there is a need for common definitions and minimum standards, and supervisory challenges and crisis management must be made or followed or set up by cross-border providers. That is how we can gain the operational resilience. To finish this presentation, we will be talking about the policy toolkit for volatile flows. As mentioned, we have macro and micro prudential. Macro fundamentals first are credible fiscal monetary frameworks. Macro prudential are leverage, liquidity, and margining tools. When we measure the capital flow, we use CFMs that are capital flow management measures. And usually they can be a part of toolkit in specific circumstances. When we have digital channels, we must think about licensing and stablecoin standards. At the end, our task would be to set up or create a scenario playbook to stress test our governance. First, there are possible shocks that we consider, and these are global tightening, volatility spike, portfolio outlaws, and forex pressure. There are triggers such as stablecoins, disruptions in payments and sales that are fired up, and amplifiers such as margin calls by NBFI and AI that can create some situations. What should be our response, liquidity backstop, and coordination, and also management that will be targeted. After action, when we do all of this, we have to clear the gaps of data, dependencies of third parties, and cooperation lessons about the cross-border relationships. What are the key takeaways from this presentation? That innovation reduces frictions, systematic risk mitigate, governance must be activity-based, data-rich, and operationally credible, and cross-border coordination is no longer optional, it is a must. So what is the next step is to create the map, and the map function all of the dependencies and do a scenario map and also do the stress testing. So we are at the end of my presentation. I hope that you enjoyed it. I hope that you also will enjoy the rest of the conference. And in the future, please join our conference again because it is a place or space for the passing of the international and global know-how, experience, and also meetings of people. And it's up to you to meet as many experts in the field as possible. So this conference will always be the place to fulfill all of these aims. So again, thank you for joining. Thank you for registering for this conference. I hope that you will enjoy all workshops that are planned for this conference, and I hope to see you in the future again. So goodbye.